Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is your Northbound Wealth Podcast, weekly market insights. Markets rise. Fed is cautious. So stocks are up for the third straight week. The S&P 500 index rose more than 0.7% this past week, led by the information technology and consumer discretionary sectors amid an onslaught of quarterly earnings and monetary policy announcement and the China trade deal. So the S&P 500 ended Friday's session at 6,840.20, bringing quarter-to-date gains to 2.3% and year-to-date growth to more than 16%. 5 members of the so-called Mag 7 group, or Magnificent 7, which compose more than a third of the S&P 500, reported earnings on Wednesday and Thursday. Shares of Amazon ended the week 8.9% higher, followed by Alphabet, which is Google, jumped 8.2%. Apple, which climbed 2.9%. Meta Platforms, which is Facebook, those shares fell more than 12% during the week, and Microsoft declined 1.1%, reflecting the impact of their planned capital expenditures related to artificial intelligence. U.S. President Donald Trump met with Chinese President Xi Jinping Thursday to finalize a one-year trade agreement between the world's largest economies that is expected to be routinely extended. China agreed to resume purchases of U.S. soybeans, keep rare earth exports flowing, and crack down on the illicit trade of fentanyl. The U.S., meanwhile, will have the tariff rate on the Asian nation related to fentanyl, cutting the overall levy to about 47%. The Federal Reserve on Wednesday last week cut interest rates by 25 basis points, but Fed Chair Jerome Powell said another reduction in December is not set in stone. Quote, in the committee's discussions at this meeting, there were strongly differing views about how to proceed in December, end quote. He said, a further reduction in the policy rate at the December meeting is not a foregone conclusion, far from it, end quote. All right. Foregone conclusions. The information technology sector had the largest percentage gain this week, up 3%, followed by a 2.8% increase in consumer discretionary peer group. 4 out of 11 sectors rose, with real estate declining 3.9% and materials shedding 3.7% respectively. I do want to point out, given that today is about 3 o'clock on Tuesday, November 4th, the broader markets, the S&P 500, the NASDAQ, the Dow, they're all selling off, especially the tech-heavy NASDAQ, which is down nearly 2%. So it looks like hitting highs and then pulling back because of valuation concerns out there in the market. So last week's gains are kind of being pulled back into view today, literally. The end of yesterday and today. Okay, moving on. Within the information technology sector, Teradyne led the pack after reporting third quarter results that beat the street's expectations, and its Q4 guidance came in above analyst projections. That ticker symbol is TER. Those shares jumped 26% this past week. The top gainer in consumer discretionary was Amazon, which reported Q3 earnings and sales that outpaced analyst estimates. Morgan Stanley said in a Friday note that Amazon is poised to see faster growth in its web services business due to expanding data center capacity, increasing chip availability, and surging backlog. On the downside, shares of Alexandria Real Estate Equities, or ticker symbol ARE, in the real estate sector sank 25%. That space has kind of been beat up lately. This past week, Q3 adjusted funds from operations and revenue fell. The company also lowered the midpoint of its adjusted FFO outlook for the full year 2025. So, as a review, the NASDAQ year to date through last week is up 22.74%. The Dow 13.24% to the positive. S&P 500 is up 17.20%. And MSCI EFA index knocking it out of the park at 27.47% year to date again. 10-year Treasury note about printed at 4.11% was the latest value as of the end of last week. Of course, markets are always moving and it's hard to stay on top of them, but thank you, White Charts, for that data. You guys provide Northbound Wealth Management with a lot of awesome data, so really appreciate it. Of course, we do pay for it. This week, key economic data. Monday would be the PMI composite manufacturing, ISM manufacturing, construction, spending, auto sales. Fed Governor Lisa Cook speaks. Tuesday would have been trade deficit, factory order jobs openings. And a lot, by the way, this is all a lot of caveat because government's closed, so we're not getting any of this data really, but this is the schedule that we're going to have to catch up on once the government reopens. Wednesday would have been ADP employment report, PMI composite services, ISM services index, weekly jobless claims productivity, wholesale inventories for Federal Reserve officials typically would be on the circuit speaking Thursday. Friday would be jobs report, consumer sentiment, credit, consumer credit, Dallas Fed, President Logan speaks. And again, the footnote on here, big time, is data for these indicators may be delayed or altogether unavailable due to the government shutdown. All right, notable companies reporting earnings. Monday would have been Palantir. So Palantir did report yesterday, and they knocked it out of the park. They did a fantastic job. But, the market ran up into earnings. And you know what? Good news is kind of a nothing burger for the market. So they decided to take profits and sell off. So I think this is just some profit taking in some of these names that have really run up to pretty steep valuations, which I don't have a problem with. I'm glad that the markets are rewarding companies that are kicking butt, taking names. Let's see, yesterday, Vertex Pharmaceuticals Incorporated also reported. Tuesday, which would be today, Advanced Micro Devices, or AMD, Shopify, Uber, Arista Networks, Amgen, Pfizer, Spotify. Wednesday, McDonald's, AppLovin, Qualcomm, Robinhood, DoorDash, McKesson Corporation, ConocoPhillips, Parker Hannifin Corporation. Friday, Berkshire Hathaway, Constellation Energy, KKR, and Duke Energy. There's plenty more, but those are the notable ones. Lots going on in these third quarter earnings reports and transcripts and stuff like that. The two types of IRS volunteer programs. This is a tax tip of the week. Every year, IRS certified volunteers help people file their tax returns. This volunteer opportunity is ideal for individuals seeking to expand their knowledge of tax prep, earn continuing education credits, or contribute to their community. The IRS offers the Volunteer Income Tax Assistance, or VITA program, and the Tax Consulting for the Elderly, TCE program. VITA offers free help to people earning $67,000 or less, people with disabilities, and limited English-speaking taxpayers. TCE is primarily for people age 60 or older. Although the program focuses on tax issues unique to seniors, most taxpayers can get free assistance. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, moving on to the next segment. Hey everybody, you've likely seen headlines comparing today's AI-driven market to the late 1990s dot-com era. We take those comparisons seriously. This particular segment outlines what's different today and what still deserves caution, and most importantly, how we're positioning your strategy if we work with you. And this is kind of how we're looking at our client situation to hold up across a range of outcomes. Valuations, that's a key component of this. Stock prices have climbed, and by simple measures of price versus earnings, the market looks more expensive than its long-term average. That's a reason for discipline. However, It is also true that the broad market remains below the most extreme levels reached in the late 1990s. You can see this in the valuation charts that track the relationship between prices and earnings over time. And I'll put a chart out there on the blog for this. What's different from .com era valuations is back then, Barron's magazine, the cover story in March of 2000 was called Burning Up. It reported that 74% of 207 publicly traded internet companies had, quote, negative cash flows. And at least 51 of those companies were projected to run out of money in the next 12 months. In contrast, today, the largest parts of the market are producing real earnings, and overall profit margins across the major U.S. indexes remain above their 5-year average. That doesn't remove risk, but it does mean that prices are supported by business results that we didn't see from the companies in the dot-com cycle back in the 2000s, 1999 to 2000. FactSet's latest quarterly review provides a good snapshot, so I put that out there on the blog. It shows the S&P 500 change in forward 12-month earnings per share versus the change in price over 10 years there. All right. So AI isn't just a story. There's heavy investment behind it. The big reason certain companies have led is the build out of the a big reason certain companies have led is the build out of the plumbing for AI. So what does that include? It includes data centers, chips, software, and power. You can see this in the government data, which shows manufacturing construction near record highs, much of it related to chip facilities and in rising business spending on information processing equipment and software. Those are dollars into real plants, servers, and tools that support future productivity. What the Federal Reserve is doing and why it matters. So the Fed lowered interest rates for the second time on October 29 and said it will stop shrinking its bond holdings on December 1st. That combination appeared to ease some pressure in financial markets without being a promise to keep cutting short-term rates from here. So we'll watch that. The message was that conditions warranted a modest step, and from here, the Fed would respond to the data. Well, the government needs to kind of open up. So about the government shutdown, government shutdowns create uncertainty and lots of media coverage. Historically, markets have often overlooked them. Returns during past shutdowns have been mixed, and many episodes have been flat to slightly positive. That's not a forecast, just context that short-term political moves haven't reliably driven long-term market outcomes. So if you work with us, and maybe if you don't, you might want to hear this. Our job is to make sure that you and your overall approach remains on track. We continuously track a core set of signals, including earnings trends, profit margins, credit conditions, employment levels, and inflation. And we adjust our approach when the facts change. And obviously, if you want to meet and discuss your portfolio and have a review, give us a call. Bottom line is, we're on top of it. If you want to talk further, 317-399-1107. Thanks for listening to the Northbound Wealth Podcast. Stay tuned for the next segment. The Federal Reserve cut interest rates for the second time this year, lowering its benchmark rate to a range of 3.75% to 4%. The move comes as policymakers weigh the economic impact of a prolonged government shutdown and slowing job growth. The Fed also announced that it will end its balance sheet runoff in December, concluding a multi-year effort to reduce its $6.6 trillion portfolio of Treasury securities and mortgage-backed securities. Two committee members dissented. One favored a larger cut, while the other was against any reduction. Officials said inflation remains, quote, somewhat elevated, end quote, but noted growing risk to employment. Markets are now watching for further signals at the Fed's December meeting, the final policy update of 2025. And I want to thank the CNBC for that particular article. I put a note out there on socials, so you can check us out on LinkedIn and or Facebook or other places, Instagram, to follow some of this news and information. And X, I forgot about X. it's there too. So check it out. All right. So preparing for healthcare needs is one of personal finance's most important and often overlooked parts. According to the 2024 Genworth Cost of Care Survey, home health aid, $77,800 per year. Okay. Plus 3% from 2023. Homemaker services costs about $75,500 per year. That's plus 10%. Okay. Assisted living, $70,800 annually. That's plus 10%. Nursing home, semi-private room, check that out. Cost, man, $111,325 per year. That's up 7%. Nursing home, private room, $127,750 per year. That's up 9%. These are, frankly, depressing and sobering numbers, but they highlight an opportunity. The earlier families begin preparing, the more options and flexibility they may have. This month reminds us of the value of preparing not only for retirement from a lifestyle perspective, but also for the possibility of care needs along the way. A thoughtful approach today might be to help preserve independence, protect assets, and ease the burden of loved ones tomorrow. So, this is in respect and honor of National Long-Term Care Awareness Month. All right. Stay tuned for the next segment. Did you know if you're over 50, a big retirement savings rule change is coming in 2026? It has to do with retirement plan catch-up contributions, the extra dollars allowed once you turn 50. So if you're 50 and older, pay attention to that. First, catch-up contributions aren't going away. You'll still be able to make them in 2026 and beyond. But here's the important difference. High earners will face a new rule. If you earned more than $145,000 from your employer in the prior year, indexed for inflation, all of your catch-up contributions will be handled differently. For some, that may mean you'll have a taxable event now, but down the road, certain retirement plan withdrawals could be tax-free. Keep in mind that many companies are updating their retirement plans to make it easier for higher earners to follow the new rule. If you earn less than $145,000, you can still choose where to place your money depending on your plan's choices. If you're turning 50 soon or already making catch-up contributions, now is the time to review your strategy and see if your plan is keeping up with the new rule. So, did you know PricewaterhouseCoopers, that's a large auditing and accounting firm, projects U.S. holiday spending will see its steepest drop since 2020. Overall spending down 5%, gift budgets down 11%, Gen Z cutting back a striking 23%. When people spend less, the real question becomes, what drives the purchases we do make? A 2023 Simple Money article, The Psychology of Holiday Spending, points out that overspending often happens when we try to recreate the holidays of our childhood with bigger or more gifts. We feel pressure to match the generosity of friends or family. Retailers remind us that time is running out and we click buy now before thinking twice. The real opportunity this season isn't about spending less, it's about spending with intention. As we know, the best gifts are rarely the ones wrapped in paper. When financial choices align with values, the holidays can feel lighter, less stressful, and more meaningful. Wishing a wonderful holiday season to you guys and all those that you love. Coming up in Thanksgiving and Christmas. And also on the public service announcement front, it's coming up in November this month. It's open enrollment season, which means it's time to review your health and benefits coverage for the year ahead. According to Fidelity, here are the general timelines to keep in mind, so you can jot these down. ACA healthcare.gov, November 1st through January 15th, 2026. Enroll by December 15th for January 1 coverage. So jot that down. Medicare, October 15th through December 7th. Separate rules apply for initial and general enrollment. Medicaid, or CHIP. Enrollment available year-round if eligible. State marketplaces. Some states have slightly different windows, so you got to check your state's site. Employer plans typically run 2 to 4 weeks in October or November. HR benefits will confirm exact dates, so check with your HR departments if you're working for somebody. The reminder is open enrollment only comes once a year. It's your chance to compare options, weigh costs, and align your coverage with your needs. And if you need to talk through those needs, benefits, and other items that your employer may offer, happy to help as much as we can. But talk to your financial professional. If we're not it, we're always here to help talk through some of those things that are personal to you. All right. Entrepreneurs take ideas and turn them into reality. They create jobs, drive innovation, and fuel the growth of our communities and economy. Working with entrepreneurs, we see the dedication and time it takes to balance today's challenges with tomorrow's vision, which sounds a lot easier than it is. Their determination and creativity inspire us, and we are proud to support them as they pursue their goals. So take a moment to celebrate the entrepreneurs around you, the risk takers, builders, and leaders who show us that progress often begins with a single step forward. Trusting yourself when others doubt, pushing through the hard times, and holding on to your vision can take courage. And that courage is worth celebrating this month and, frankly, every day. This is National Entrepreneurs Month, I would have to portend and say. There is a particular day coming up that we celebrate that, but here in a couple of weeks. But I just think entrepreneurs are really the ones who drive the economy. They are the engine of the United States economy. So honor those people that are out there working hard, taking those risks. So did you know November may be the most important month for your taxes, and this year the opportunities may be bigger than usual. The One Big Beautiful Bill, OBBB Act, creates some unique year-end opportunities. Here are a few highlights worth noting. Higher standard deduction through 2025 means more taxpayers might not need to itemize. New deductions for seniors, overtime pay, and even tipped income offers ways to manage taxable income. Charitable giving strategies, especially donating appreciated assets, can be some year-end tax moves to consider. Thoughtful steps now could help you manage your 2025 tax bill. If any of these ideas interest you, or if you have other ideas, we might be able to provide you with some additional information on new tax laws. But we would encourage you to check in with your tax, legal, or accounting professional before making any changes or decisions. Also, did you know 3 shocking realities most families miss when it comes to wealth transfer, which is going on at a faster and faster pace over these days and over the next couple of decades? The top reason why wealth transfer strategies fail is a lack of communication and trust. That's about a 60%, probability there. Your retirement plan beneficiary designation overrides your will. That's a common one. Most heirs must withdraw inherited retirement accounts within 10 years. This could have wide-ranging implications. Here's the surprising part, though. The biggest reason wealth fails to transfer isn't bad investments, it's lack of communication. What your adult children need to know, okay? So if you're going to have these conversations or really wanting to get on top of it financially, number 1, where your retirement income comes from. Number 2, how bills are paid and where passwords are stored. Number 3, who your financial team is and how to reach them. Number 4, who has power of attorney and who's the executor. And number 5, the why behind your financial decisions. Probably need to tell them why. Okay, why now? Why have this discussion now? Well, that's because holiday gatherings create rare moments when everyone's together and the mood is about gratitude. Can we talk through the basics? Maybe you say something like that. Families who succeed at wealth transfer aren't the ones with the most money. They're actually the ones who talk about it. If you want to learn more, we'll have a chat. Feel free to reach out to us at Northbound Wealth Management. We'd be happy to talk with you. Hello, everyone. This is Brent Foster. This is your technical analysis spotlight. I'm going to briefly talk about it. It looks like the equity markets and the internals are kind of selling off. We've had quite the run up since April, since the trade war and tariffs. Markets have really ripped from that bottom. It's one of the quickest, most historic moves that we've seen in the S&P 500 historically. It's amazing. We were very, very oversold, and now we are in a overbought condition. And the exponential moving averages are trending down now, and we've had some internal weakness, even though and despite prices moving higher. So, from a technical perspective, it's we kind of saw this coming. There was going to be a run up, a rally, and then a pullback in the near term. Some consolidation is actually a healthy thing. We shouldn't see markets just go up in a straight line and then never correct. Yesterday on the Bloomberg, I listened to a bunch of different CEOs of banks and other industries talking about, especially the wealth management industries like Morgan Stanley and the others, and they're all saying, "Hey, in the next 12 to 24 months, we should see a correction of." I heard in numbers from 10 to 15%, 10 to 20%, 15 to 20%, all of that type of stuff. And what stands out to me is that's not like some sort of crazy throw it out there type of thing to say. It's actually standard and common to see intra-year declines of around 14 to 15%. And a lot of people forget that the markets do trade up and they trade down. And so long as the trend is bullish, which I still believe is the case, the trend is bullish, that buying and selling, if you have an asset allocation that's specific to your unique goals and objectives and suitability and all that kind of stuff, great. But it's a good time to review that strategy, see where rebalancing might benefit you, or tax planning or financial planning, how that plays a part in making asset allocation decisions. And talking with your financial professionals, a good place to start. They can add oftentimes what they call alpha as far as a benefit and a value to you, more than you just trying to make decisions on your own and cutting through all the noise of pundits and media and social media and market news and buy now, sell now, short the market. I mean, you got all kinds of commentary coming out, but I think it's really smart to have a solid financial plan, stick to the plan, stick to the allocation, adjust where needed. And those decisions can be helped out tremendously by working with someone. When I look at the market can have overbought conditions and oversold conditions. The trend is actually bullish. So when we get overbought, sometimes we sell off over 4 to 6 weeks or 4 to 8 weeks, and then we rally again. And sometimes we have higher levels of volatility because of uncertainty out there in the market. And maybe valuations get a little bit stretched, like Nvidia or Palantir. They kind of get a little out there ahead of their skis. But if you zoom out and look out over the next 10 to 15 years, what does the theme look like? What does that business cycle look like? I think AI is not going anywhere. I don't think that robotics is going anywhere. It's only going to improve automation, productivity efficiencies, and things like that. And so the Fed has lowered rates a little bit to try to help ease the pressure in the housing market. There's a whole lot going on out there, you guys. And so I think that if you develop a solid plan, strategy, asset allocation, and you kind of periodically review your financial goals, you'll be well on your way to doing well and being a good steward of the assets that God has given you. So, anyway, Not a ton of technical commentary there, but I did want to just share some of that information with you. And I hope you guys have a great week and weekend. Take care, and we'll talk to you soon. Thanks.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.